Most of the funding the aggregators use for acquisitions has been raised in the form of debt. And due to high interest rates, the cost of money is rising. If you are new, my name is Michael and we scaled our business to 8 figures and now I make videos about Amazon FBA. So let's dive in. So I will split this video into 2 parts. The first one, I will tell you why you should not sell your Amazon FBA business, and the second part will be all about the stuff you should do instead. So if you look at the valuation you can potentially get for your business, we will use this simplified formula. Obviously, there is way more stuff going into this, but for the purpose of this video, this is essentially the formula, right? You have your profits multiplied by the acquisition multiple, and your profits are revenue multiplied by your margin. So if we take a look at a simple calculation, we will have revenue around 1 million. If margins are 20%, we have $200,000 profit, the acquisition multiple 3. So you can expect sales proceeds in around $600,000. It is as simple as that, right? But we will focus on a specific factors that should tell you why you should not sell your business right now. And the first factor we are going to look at are our margins. And essentially this chart will tell you all you need to know, because this chart represents the cost of containers shipped from China to US. And if you are selling on Amazon, you probably know that a year ago, the prices were extremely high, and just about now they are going back to normal. So especially this section of the chart will tell us everything we need to know, because if we are calculating our margins from the last 12 months for the valuation, pretty much all of the spikes in the supply chain costs, in the shipping costs, will be still reflected in our cost of goods. So all of the extremely high shipping costs are still there. These are the last 12 months. We are now going back to normal, but all of this is still reflected in our cost of goods, which will negatively affect our margin. And as you can see, the difference is quite significant. The drop in shipping costs is around 70 to 80%. And this overall has a huge impact on our margins. And we have to keep in mind that the low margins will also hurt our multiple, because around 1/3 of the aggregators are not really interested in businesses with margins lower than 20%. This is data from 2021, but it will be very similar nowadays. So if we know that with these lower shipping costs, our margins are higher, even just by 2 percentage points, as in this example, if we increase our margins from 20%, which we got with these high shipping costs, now we can assume even if we would increase only by 2 percentage points to 22%, we would increase our sale proceeds by 10%. And this is still very conservative, because if you had 20% margins with these shipping costs, it is very likely that now you would have higher margins, 25%, 26%. And as you can see, even the slightest change in margins is increasing our sales proceeds significantly. The second part is revenue. And once again, we are looking at the shipping costs, because throughout 2022 and 2021, everyone had issues with their supply chain. There were delays and a lot of sellers went out of stock. So I recommend you to look back and in the last 12 months and analyze how much profit you actually lost due to out of stock periods. Because it is very likely that some of your products ran out of stock, and it was the case for most sellers because all of the shipments were delayed weeks and weeks. So it is realistic to assume that a lot of your products ran out of stock for weeks, if not months, right? So once again, conservative assumption based on my experience with other sellers and based on experience with our business can be around 10 to 15% of revenue lost due to out-of-stock periods that were once again caused by the supply chain issues. And just going back to our simple formula, if we would be selling during these out-of-stock periods and increase our revenue by just 15%, once again, we would increase our estimated sales proceeds by around $90,000 just by increasing our revenue by $150,000, which is essentially the revenue we lost due to the out-of-stock periods, right? And the third section, probably the most important one, is the actual acquisition multiple, because we have to understand that most of the funding the aggregators use for acquisitions has been raised in the form of debt. And due to high interest rates, the cost of money is rising. So if we take a look at a simple overview of the capital raised by Amazon aggregators, we will see that in 2022, the average is going down significantly, which means that the aggregators have less money to acquire new businesses. And as you can see, this chart is going all the way to October, November, December 2022. So the amount of money they raise is going down significantly. And due to this, many buyers, many aggregators are actually shifting their focus to operations. They are trying to optimize their operations in order to grow the businesses they already acquired in the years before. And as you can see, some of the large aggregators are actually announcing layoffs, and they are pretty much stopping the acquisition completely. So as you can see, Thrashio, for example, is laying off about 20% of its staff so they can optimize their operations and minimize the costs. So there are essentially two results. The first one, the biggest problem, are lower multiples. So if we compare 2021 with 2022, so we have the low, mid, and high multiples for businesses in 2021, and then the difference in 2022. As you can see, the high range suffered the most, but pretty much all of the multiples are going down for all of the reasons I explained before. And the second problem is that we will have fewer potential buyers for our brand, because more and more aggregators have realized that there are operational advantages to focusing on one niche or category. So they are less likely to buy all of the brands that are all over the place. They are likely to focus on a specific niche, because by narrowing their focus, they can create efficient growth strategies that are scalable across their portfolio of brands, which means that there will be fewer buyers interested in your specific brand. And once again, fewer buyers likely means that you will be less likely to achieve a high multiple. That's the difference between having 2 potential buyers and, let's say, 6 potential buyers. And if we go back to our simple calculation, the difference between acquisition multiple of 3 and 3.5 is once again around $100,000. The difference is huge. Everything else is the same, the revenue, the margin, just the multiple changed slightly, and now we are looking at a completely different outcome. And the last point is the actual valuation, because the valuation is not necessarily what you will get in cash, because the deal structure ratio is changing as well, because we are shifting away from upfront cash that you would get for your business toward earnouts. That means that you will get your money based on the brand's performance once the aggregator actually acquires your brand. So the buyers, the aggregators, are trying to de-risk their acquisition process, and this is obviously an increased risk on your end, because there is a chance that you won't actually get all of the money from the valuation if the brand is not performing well. Well, and if we combine all of these factors, the cost of goods, the lost revenue, the acquisition multiple, we are looking at a completely different outcome. So in one scenario, we have our 1 million revenue, 20% margin, 200,000 profit, acquisition multiple of 3, that's around $600,000 in sales proceeds. But now let's increase the revenue by the revenue we potentially lost during our out of stock periods, now increase the margin since the shipping costs are down, and now also increase the acquisition multiple. That would reflect more optimistic times. So let's say 3.5. And the sale proceeds are almost 50% higher than in the first scenario. So as you can see, we made a few tweaks here and there, and we get a completely different outcome. And this is the main reason why you should not sell your Amazon FBA business right now. It is simply not a good time for most sellers. By the way, all of the resources I mentioned in this video will be linked below. So now let's figure out what should we do instead. First of all, we have to understand that the buyers, the aggregators, they are buying the growth potential. They are not buying the asset just to wait 3 or 5 years to get their money back, right? If they are paying you the multiple of 3, they are not going to wait 3 years to get their money back. They are buying the potential, the growth potential of the brand. And if you personally don't see the potential, or your business is falling apart, so you want to get rid of it, you are not in a good position to negotiate. So obviously we have to fix this first. And really the best position to be in when you are selling your business is that you don't really need to sell it, which means that your operations are running smoothly and you have some growth plan in place, ideally a strategy to at least double your business in the next year or 2 years. So just to give you an idea of what we did when we were selling our business, we had a very detailed growth plan in place, which was essentially a step-by-step plan to double the business in 1 or 2 years. All of the products to launch, the growth plan included around 8 products that were pretty much finished in the product development pipeline. So the only thing they had to do is to launch the products. We also planned marketplace expansion, including all of the revenue estimates, keyword research, all of that was in place so we could estimate the revenue growth out of that expansion. The same goes for the products, right? And we also had new branding and marketing projects. We had new videos, new photos coming in, so they could use it to optimize the listings. So this growth plan was like 10 pages, step by step, what you have to do, what you have to implement, and what is the estimated revenue growth. And the idea is that this growth plan was for us. But once we were selling the business, we could show them like, this is what you have to do with the business in order to get a good return on your investment. So we were able to show them the growth potential. So the business looked more desirable, right? First of all, you want a growth plan for yourself, but ideally once you are selling the business, you still should have an idea how to grow the business. Because if you don't have an idea how to grow it as the owner, so how the aggregator should know what to do with the business if they are new in that market, for example. So really now it's time to work, learn, and grow. And probably the best thought exercise here is to imagine you just bought your business. What would you do to get a good return on your investment? And this should be your action plan. So step 1 would be to optimize. You have to keep in mind that every extra dollar in profit you get is multiplied in the valuation, right? Whether it's 3x or 4x, every single dollar is multiplied. So invest in your listings, get better photos, get better videos, better listing copy to optimize your conversion rates. Also negotiate supply chain pricing with your suppliers, forwarders, and 3PL. Once again, every single dollar counts multiple times. And the same goes for PPC management. Even just a few percentage points in ACOS is a huge difference in the long run, especially if you are selling your business. Step 2 would be to grow, to leverage your existing assets, add new product variations, right? Most of the work has been already done. Once you launch a product, it's working well. Add new variations to increase the revenue and the profits. Also, once you have established product lines in one marketplace, make sure to expand to a new marketplace. Leverage what you've already built. And also make sure to create a proper growth plan. As I said, analyze the opportunity and figure out the growth projects that have high potential for your particular business. And ideally, the rule of thumb should be that you should know at all times how to double your business. What is the path forward? How would I double my business? And in a year from now, even if I double it, once again, I want another plan in place and I want to know how to double my business once again. I need to understand the projects that have the potential to get me there. And the last step is to plan your exit. Because the last 12 months before you actually sell the business are most important. So those should be the best 12 months possible. Minimize all of the out-of-stock periods. Avoid any risky investments that could ruin your profits. Account suspensions and everything like that will affect your annual revenue and your annual profit. So keep that in mind that these really should be the best 12 months possible. I also recommend you to work with a professional accountant to really understand your numbers so you really know what is going on in your business. And most importantly, do not rely on the exit. Always continue to focus on running the business during the negotiation and the sale of the business. Because you could negotiate for 2 months and you could feel like, okay, I'm going to sell this business. I don't have to launch new products. I don't have to expand to new marketplaces. I don't have to optimize whatever. And then the deal will fall off and you will lose those 2-3 months. So always focus on running the business and having the plan, having the growth in mind, even if you are negotiating. The only moment where you stop is when you actually transfer the account ownership to the buyer. So if you want to see how to plan projects for your Amazon FBA business, make sure to check out this video. I hope it helps. Bye.